Hey team, Trader Romps here. As I said from the prep, I was actually just going to go over some of the little bit of education point that I added in, which is recency versus duration with TPOs. We can sort of, for some of you who have done the advanced course, if you're having a read over this and you're a little bit more interested in it, I thought I'd just do a quick video explaining sort of like when we build composites and how they work, the 50% rule, and then just breaking this down into a little bit more of a video format. Because obviously just reading and actually looking at the pictures can be perhaps a little bit hard if you're not completely on the same page with TPO and the charts and that sort of thing. So we jump over at the moment into exo charts here. I'd recommend still just having a quick read over this. I won't go through everything, but you can see in the blue, so the blue box, we had 14 days worth of price action before we had that large inside day, and then obviously we traded in and out of it, putting some composites and that sort of thing in. But each time we've come back, we've found the rotational point of majority of this range has fallen in that 14 days, and then it's got caught back up once we've got over to where we had a composite above. We try to retest the top of that 14-day composite, and then we failed to get it back above the high of that composite in the high. And then after that, once we had that rejection and that big fall below this composite, it was pretty clear that we were going to see the bottom of the 14-day again. So then after that happened, we ended up with these green lines now, this green box through here, and that's a now 19-day composite. So when we create composites, we'll just start over here on the more recent duration. The ways you can do is you can right click and you can click merge TPO profile, and you see it will merge it to the left. The other way to do it as well is we can go to the latest that's not the actual developing, but the latest value. We can right click on it and we can click merge X profile. So from here, we know that there was 19. I've clicked on that one. So we count that one and we say, well, we want 18 of them. And it's just a real quick way to create all 18. And then that will also spit out the value area high and low. So if I just turn off all of these for a moment, you'll see where we actually have this dash line. So that's the value area high. That's now the 19-day value area high and 19-day value area low. So I'll turn these back on just to put a bit of lipstick back on the chart. And we can see that that's how we have that composite. So just a quick little lesson. We'll probably use an area just down here for sort of looking at the recent price action, for instance. So if we're looking at this profile, and this profile, well, what we end up getting from that is we have all of this value we opened within. So you can see the little green square we opened within the day before. And so we would merge that. So when we've now merged that, we've got this shape profile, and then we had the next day open and it closed up here, but we still had this darker blue area within inside the profile before that. So if you merge that there like so, we've now got a 3-day profile. So what we could do is we would have, and I haven't done it, but we'll do it now. We'll put this box in through here and we can see that we have this 3-day profile. I'll change the color. We'll just make it stand out a little bit more, make it like an orange or something like that. And then what we're going to get from this is if I reset all the profiles so we can still see them individual, we can now see that what we had was the next day opened, it came down and it retested not only the 3-day composite value area high, but it also retested the previous day point of control. And then we had a big breakaway. Now, just quickly, a quick lesson on this, for instance, is when we are just looking to isolate these profiles, so not talking about the duration part, but just to isolate them, I mentioned the 50% rule. So for those who are not too sure what I'm talking about when it comes to that, is if you have a profile, the value area low and the value area high, and then the next day creates a profile, like so, and you had the value area low and the value area high, this area in here, if it's not 50%, and in this case it wouldn't be, we don't merge them. So the value that I'm talking about merging at least 50%, it's a bit of art versus science, you will get better at it, but is the actual value area high, the value area high and low. We're not actually looking for that upper and lower portion. So we don't include this and we don't include this, we just include basically the meat of the profile. So if to make that example, how I would merge it would be if we had a profile and then we had another profile like so. And these can be B, D, whatever, lowercase b, etc. Doesn't matter. I'm just making it easy with straight normal day clear D, capital D distributions. So if you have your point of control here and your point of control here, then you would merge these two into that composite. And we would just go on and on and on and on. But the part that gets a little bit harder is when it comes to recency, that's really easy. That's just a 50% rule. As you get more advanced, there will be times that you might go, I don't like the look of that, but without being confusing, especially if you're just getting into this, that's the recency side of things. And that's exactly what we just did down here. So we have that 3-day profile inside of the recency. We can see that we didn't merge this one here into here. And why didn't we do that? When we come in and have a quick look at it, we can see that we had, here's the value area high, the value area low. And then the next one opened, we don't include this, the next one opened down here, and the value area high and the value area low. So these are not mergeable. This is actually moving down and lower time frame, it's actually trending down. But the difference was obviously with these next three was quite easy. It's because we had really a good example is actually the value area high, the value area high, and the value area high. So this was like textbook, merge, merge, merge. And that's how we end up with the 3-day CVA, 3-day composite value area. And that is this area through here, and everything else, we don't really even need to worry about it. We just know that every time we got to here, we would have responsive sellers. And obviously when we got down under this level here, we had the responsive buyer stepping in. So this would have been a great entry without being confusing. It's a nice big thin spot through there as well. So that's sort of like smaller fair value gaps. I'll see if you've done that part of the course. So that is duration. That is sort of just looking at composites. That's looking at the recency of how easy it is to actually create and combine these composites. But I had a question from a student earlier on, and they said to me, why am I adding this composite? And to recency, it's correct that we're not adding it to here. And something else to add on top of that as well, though, is this by itself, this type of a breakaway, when it's alone, and what I mean by when it's alone would be, let's see if the computer's still got the data. So say down here where we were trending, when we start getting things like this, right? And look, we pushed again, even here, not a great example because we have an imbalance, but this is better because we've actually broken away from value. So a quick example here would be, in a way we're trending, there's a bit of 50% of value. So if we did say merge that as a profile, for instance, we also have these other composites without being confusing, but let's say we just isolate that and we have that as the 2-day. And then we did open balance. We came down and we hit the 2-day point of control, and then we migrated up higher. Now this would be the same scenario as we were just talking about as to, let's reset that, as to having those two, and then this time we wouldn't merge that because there's not the 50% from these two of overlap, just like back over here, just to remind you again, we had the 3 days and we had the clear breakaway. So this would not be merged. So as far as recency goes, and if we were just isolating this by itself, would say, hey, this is really bullish. This is looking really good. Now I'm going to say why at the moment, and you may have already caught on to as to why it's not as bullish as this scenario. Now, explaining that, this scenario would be a breakaway from these two composites. Now you could argue that there was a naked value area high over here, etc. But to keep it simple, let's not think about that being a bit of value. Let's just see this as just as it was a strong uptrend, yeah? So as it's moving away and we had that breakaway, there was nothing at all to the left of this that would be saying, hang on, what about the duration side of things? And that's what we get when we get these range-bound consolidation environments. This is a trending leg up, a trending leg down, a mark up, a mark down. This kind of thing is just screaming, hey, I want to go higher. And this is where it can get more difficult. We had the 14 days of value, like so, and then we had a rejoin of the old 14, which I was using for a long time, and now this is built out as the primary of the 19 day as of yesterday's being merged. Now, this is where the 50% rule doesn't come into play, is because you will get, once you've got that boundary that's happened over time, that anything, any shape, it doesn't matter what kind of breakaway it does from value, it is just absorbed into all of this, if that makes sense. Now, if we were to sort of look at this to be a little bit more clear as we went, right? And we were to look at the fact that we had this profile up through here. Let's zoom in on it. And you can see that we've broken away from that profile down here. So there was no merging. Then this profile happened and it would have been a standalone profile. Merging down, okay? Did we merge this one here? No, we didn't merge this one here. So this is the part that gets a little bit more confusing. But then what happened? Then we had this profile here. It came up here, it closed down here, but the value of this one here to this one here and the rejections of this up here said, hang on, we can now grab this one here and this one here, because combining that, and that, we now actually have that sort of 50% of overlap. But I don't even see it that way. I just see it as we're now in that sort of bracketing. And if we actually do go through and look at how it would have happened to the part that we said we want to do our first merge, it was no, strong downtrend, no, strong downtrend, very washed up through here, but I'm not counting this value. I'm counting this is where majority is happening. Then we have this here. So now this value. So by the time we had these two profiles, I'm going to start seeing how it looks. And we started with something like this, but you can see immediately with this value area high and this value area low down through here, which at the time was lining up with the 14 day. Keep in mind the green lines don't count at the moment because they don't exist, which is the 19 now. So the 14 day, we can see the reactions that we're having at the 14 and how the value areas were still remaining fairly low, but the closes weren't getting above it. So that's sort of, this is the part where you go, okay, the old 14 day, it was a lot of price action. It was the meat of the inside day where we had a crazy volatile day. And now we can see as we go through, it doesn't matter what they are, as long as they're within that boundary, we can just basically keep going and going and going. Keep in mind, this is where the values are. So we've got 50% inside that value. Then the values here, 50% inside that one, and so on. And even when you may come to a point, I'm not sure if we had one in here where it would break away from values. No, we didn't know. But every now and then you might stop, a profile close below, and then a profile opens back up again and moves forward. That's where I will allow sort of one profile to go, because it was almost just like a responsive day of price action to actually get back inside that profile. What I mean by that is the difference is, if we were looking at this 14 day, keep an eye on that blue line there, we got a few days of like a clear day of breakaway and another clear day of breakaway, and we created a new composite. That's broken now. The 14 day ended here. If this went up here, maybe had one more day and then closed in here again, I might grab hold of it, similar to what would have happened over here. So this is what I'm talking about, where you have sort of just that 1, 2, 3, and then you're back in again. So I'm going to incorporate the whole thing. But if you are going to go down, 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 play around here for a bit, and then come back up, I'm pretty much closing off that here and going to start back over here again. But I still am aware of it. I can still mark it. And that's the reason the 14 day stood out for me as well, was because I had the 14 in. I kept, because of so much of it was inside that inside day, and then it was marked on my chart, and I would have been doing my internal composites and seeing how it reacted. But recently, when we came back into this area, you can see that 14 day has continued on. So it's almost like we've got re-hooked back into that one. but I'm not going to, there's nothing I can really do, not in exo charts at least. Sierra charts, it's like you can do a bit more if you wanted to go deep and try and isolate that with that, but we get the idea. It doesn't really matter that much. The 14 and now 19 days, so 33 days of value area high and value area low in this area is places that we will remain rotational. So it's just normal rotations until proven otherwise. Obviously, when we push up through here, actually, I'll just quickly show the, I didn't really mention this in the prep. I sort of had a quick mention in the prep where we have the like developing yearly and developing quarterly. And that also comes in over here on the February the 7th value area high right through here. So you can start seeing essentially, you can start seeing from here that if we were to break up and roll back in, we just remain rotational within the 19 days. Now, we still look at recency though. Well, hang on, I said we have a line in the sand, which is the previous day, consolidate, move up, break under, we could come back down, swing that again and go again. So this is where you can get the compression above this area. You know, we've also got these anomalies now. Now, there'll always be anomalies left. We can't always have a balanced chart. That's the idea of being in balance. So we know if we come down, we have the NPOC, we have the previous day, and then we also now have the 3-day down below, which is a little bit of meat to potentially come down here and push back up for a rotational to sort of get a front run from that level. So a front run is still something that we could happen. We could rotate for another month or two, you know, so we're aware that anything can happen. And that's why, like, you know, saying, oh, if we're going to go long off here, you know, and take out behind there, there's just some normal standard highs. The value area high that's naked is definitely a point, and we could look at the long-term VWAPs and that sort of thing as well. And we obviously know there's a lot of resistance and sort of just like within this section as well, we have the previous quarter value area high. So we bring all those sort of volume levels, and we sort of come in here and we look at the time and we get a bit of an idea. So recency, if we had this profile and it had opened, you know, I'm going to ignore this again because we do need to look at it, but let's just say this didn't exist. This profile opened like way up here, especially we had some single prints. So some single prints down here, and then we open up through here. This is just saying, hey, I'm ready to go trending. But at the moment, even though the recency is telling us that, like, you know, 3 days, clear breakaway, no, not merging out of there, whether it's short liquidations or actual bulls, we've got like a lot of the buy delta that's sitting, protecting along the top. You know, we've got some shorts down through here that are trapped that could have been a part of pushing this out. You know, I need to sort of jump on the footprint charts to have a look. But, you know, we're sitting above that value area high. So we do remain above that. Then this level here, or potentially fully come above it, we have that consolidation, and then we actually move higher towards more of these higher levels up through here. But while we remain rotational, we need to be rotational. So the swing trades, but obviously when we're looking at duration, and that's sort of, I guess we could drop back for a second to again talk about duration. More from a narrative read is something else that I was bringing up, and that is where we're actually looking at the greater picture here, and that would be like, where are we in respect to now this area through here? So whenever, you know, we come under it each time, you can see it was a buyback. Now there's times that we consolidated under it. So this is, again, not a short time frame. We're under, let's go, buy. We need to use recency, but we would use recency when we're actually underneath it. So some of them were a quick buyback where the responsive buyers come in. If you're on lower time frames, you could be going, I'm actually willing to lose here when I take a long trade because we're underneath and I'm going to become a responsive buyer. So if you look at how many times, even some of these deeper things each time, we've been bought back up inside of here. The point I'm trying to make is, if you buy here or you sell here or you buy or you sell or whatever all through here, unless you're being very, very aggressive and you've dialed down your lower time frame, you know, your PD raise, your order blocks, that sort of thing, and you literally know that you're going to get in and out ideally as quick as possible, then you can scalp money. You're obviously inheriting a lot of risk doing that. So again, your position size needs to be low, and you know, people who do that, it's more because it's a hobby. It's sort of more fun. Like, you actually enjoy trading. You're not in there trying to make $1 million, but it's these entries down here is the one, it's probably a good example because it was off a naked NPOC down through there, right? So the thought process would be at the time, remember the 19 days doesn't exist, but the 14 days do exist. And we also have, what is this? 1, 2, 3, 4, 5, 6. So we have a 6-day composite here. 1, 2, 3, 4, 5, 6. So we have, 12 days combined, 2 individual 6-day composites, and we swept below it, at least for that 6, we swept below, sorry, not this one. We had these ones here, and this one here, when we swept below, we came down to that naked point of control that was a part of that composite there. And the thought process is, I'm below the 14-day. This is where I risk on. Now, yes, it can continue rotating, but the stops are very, very defined and clear. So you get the end pocket on the lower time frame. We're not seeing anything on the TPO. This is our narrative read, but on the trend reversal charts or the footprint charts or just trading view or whatever you use, this is where we've hit the end pop through there. We've seen some price action starting to buy back up. We have a really clear, defined stop loss for it to rotate back up higher, to be that responsive buyer for the expectation of where would the take profits be in this case? Well, one would be the 14-day CBAR. Why? Because it can be the bearish retest that does go lower. The next one would be just the 14-day CVAH, so CVA, because that's just going to be the traverse trade. And then after that, you can leave someone to run, hopefully for all-time high. But if you start seeing some weaknesses, it's almost like NPOC to NPOC here, big sell tail, closed here, yet nasty sell tail over here, you might close your trade because it's cooked and you're waiting for something else to happen. In this case, we did close that up here. We opened up. We failed to get into this old single day profile with the value area high and the value area low. So you can read the narrative. It just basically rolled from here. And once we accepted back inside some of these other composites in the 14-day, then you know that we're just back to that boring rotation. So hopefully it's not too confusing, but that's how, when I'm talking the differences between recency, meaning where did we open in respect to yesterday? Where did we open in respect to the last few days? This is like equivalent to looking at this on like a 5-minute chart. And you can't just base your analysis. You need to zoom out. And that's where the power of this comes in, to give confidence, to build bias. We're trending. Are we ranging? Well, we're ranging at the moment. We are still ranging in the new 19-day and the 14-day. So, it looks good, low time frame, 3 days, nice push up higher. But the reality is, this is what we get until we have something clear that breaks either way. Cool. So hopefully that cleared it up. Something else you can do as well. So I know some of you might be, getting into this and being like, yeah, you get it, but you're like, it's nasty and I don't want to always have to be looking at this and, all these different boxes and stuff. And look, that's all well and good. But what you can do is just go, okay, well, I think I took an average here of the 14, the 19s, and just brought them over onto a trading view chart. And I put that up as well. And you can pretty much just see, straight away, it's the exact same thing. But we know, like, whenever we're in these areas down through here, and we, still got that bullish bias, we should be, expecting for higher prices. And, because we're in an uptrend, we're going to be a little bit more hopeful with these that they're going to continue through. But the thing as well that we had, just let me see, why is this first time using this tool here? So we had that composite that came in roughly somewhere through, at least the value area high was there. And then we had this 14. So like the way a narrative would read, even just with this like sort of 14-day up, and you can see how good the interactions and stuff were each time. But what you can see is you came up, we had this value area that was being built, and we had this, and this was almost like a yes, let's go, because it gave us that time and space. But what we failed to do was break the value area high of this composite that was in here, and from that point, once we rolled down, especially, I think we had to close down through here. Not only had we lost this profile, with the, this entire area becomes a failed auction. So we rejected that, we closed down here. So now what ends up happening is we can pretty much just clearly see that we've closed here. This is expected to be a failed auction, and we're expected to rotate through here. And that's obviously, we had the NPOC here, we had an NPOC here, and ever since we've just been rotating between. So the time and space thing that I mentioned here, like that let's go, when we got here, we're now getting that because we've got that time and space in here, time and space in here. Now, where are we? We're in the exact same situation as we were. We were rejected here, and we could reject here. So the difference now of the narrative, you know, the rhythm of the history repeating itself, rhyming, etc., is we don't want to see this head down through here. Ideally, I want to see something different. Look, you'll give the grace period for the naked bow, the 3-day that we had through here, you know, the previous day value area high that we're sort of consolidating off at the moment, to hopefully get that push up through here. But definitely I was thinking, once I started seeing this, I said last week, I believe this week we should get something. And we have got something, but we need to be mindful that at the end of the day, the 14, the 19 through here, the 33 in total, we need to understand that we are rotational. We need to expect the same until proven otherwise. Don't be a hero and put your whole bag on here. That was for here. That was for here. Because remember, clear invalidations, you're allowed to be wrong here. You've got your risk management on point. But if you're going long up through here and you're not a day trader, because you understand the value area low is the stop loss, but you're looking at this from zoomed out and you're going to go, no, I've gone to the moon, and then we rotate back down to here again. This could be a liquidation or a lot of pain for some in a small area, especially for those who aren't using leverage risk management properly. Getting a little bit too excited, that sort of thing. But yeah, so that's my spiel. Hopefully I've cleared some things up. Maybe you've learned some stuff. Maybe you haven't. Have a chat with me. I can do more of these videos, but yeah, bottom line is just understanding that recency, which 3-day, previous day profile, where we trade now, is all good. But until you actually zoom out, like the higher time frame analysis, the narrative read, the failed auctions, the failed auction under, the failed auction over, etc., and we've got those really, really clear high time frame lines in the sand. This is like your weekly, your monthly, your quarterly, your yearly. Well, in this case, this is this range. It's personal value area high and value area low. So it works combined with, you know, your developings and stuff, but these are the big ones that I'll be looking at. Look, the only thing that's probably bigger and it actually comes in near here is like, you know, your previous quarter being a large amount of time. But this one here, besides your yearly, is probably your 2 highest time frame levels. And the difference as well is like a previous year value area high now is its last year. Whereas this is the best of both worlds of duration versus recency, being as this is the most recent duration of value. So it's got the best of both worlds, being it's heavy, but it's really strong in its own way, that it's still in the scope of what's going on in price action. So awesome. Any questions, hit me up in the chat. Hope that was clear for you.